Hello everybody, Debbie Taylor here, Chief Tax Strategist and Managing Partner at Carson Wealth. And I'm here to talk to you today about one of the personas, is what I'm calling it, group of people that were able to benefit from the OBBA. Now the OBBA has a lot of provisions and a lot of folks that benefit from it. Today we're going to talk about working clients, wage earners, families. That's what we're going to focus on today. And so we're also going to talk about how these folks benefit not just from OBBA, but the integration of other tax laws, and really think of like a 5 or 10 layer cake where it's layer on top of layer on top of layer. So think TCJA, Secure Act 2.0, OBBA, and then all of the laws that were passed in the middle of those pieces of legislation. And so what are some things that working clients and families, wage earners should be thinking about? Is remember now, there are higher contribution limits under Secure Act 2.0. Those catch-up contributions, age 60 to 63, are now available. Also remember that if you made $150,000 last year from one employer, you're required to do your catch-up contributions in a Roth 401k, right? Roth 401k. So between the catch-up contributions, the traditional ones, and then if you're age 60 to 63, your enhanced catch-up contributions all need to be Roth. If you made over $150,000 last year with one employer, you need to think about that. So we love Roth accounts, don't get me wrong, but that might change your tax situation slightly because all this extra money is going into a Roth account. So we want to be sensitive to that, but also take advantage of it where possible. Remember that there's auto enrollment and auto escalation with new 401k plans, right? Also, unfortunately, some of the Affordable Care Act subsidies obviously have tightened up coming into 2026. And so we need to factor that into our tax planning and our cash flow planning until that gets, addressed. Remember, for new vehicles, there's an auto loan interest deduction of up to $10,000. Now, there's a bunch of rules with that. You got to pull the VIN number and refer to it. It's got to be a new vehicle. It's got to be assembled here. But here's what's sort of interesting. To get that $10,000 deduction for auto loan interest, you literally would have to be buying a car that was worth over $100,000, like a Bentley or something like that. And most folks that are making under $250,000 a year, which is the income limitation, most folks that are making under $250,000 a year are not out buying $100,000 plus cars, right? So that $10,000 auto loan interest deduction, you probably aren't going to get $10,000. Maybe you'll get a few thousand, but something is better than nothing. Let's make sure we're taking advantage of Roth conversion still. Remember, these tax brackets are low and they're continuing to be low. So let's not get complacent. Let's do tax planning now. Okay, let's not forget the child tax credit, and there's a refundable portion in the child tax credit, and that's going to expand every year for inflation. And also remember, there is a dependent care credit, so let's try to qualify for those things. There is a student loan employer match that's allowed to be done by your employer. So check your benefit plans to see if that's something that's available. And let's also not forget Trump accounts coming online in July. Let's grab that $1,000 for those newborns and possibly start funding retirement accounts for children or grandchildren under the age of 18. That's pretty cool because you don't need earned income, and yet you can start funding those Trump accounts, which are the equivalent of IRAs. Remember also, no tax on tips, that deduction, no tax on overtime. Yes, there are limitations around those, but those are available to us. And so let's be strategic and let's make sure we qualify for those, right? And so super exciting for those families that are working every day, dealing with inflation. Lots of opportunities here as a result of Secure Act 2.0, OBBA, and the other tax laws. So let's make sure that we're intentional and thoughtful. And with that then, thank you and happy tax planning.